Let's work problem exercise 23.3 from chapter 21. So this is Tavares Company, and this has to do with the change in accounting. So as always, let's take a look at the problem, note the facts, set it up, and then solve for the requirements. So Tavares Company decides at the beginning of 2025 to adopt the FIFO method of inventory valuation. Tavares had used the LIFO method for financial reporting since its inception on January 1st, 2023, and has the records necessary to apply the FIFO method retrospectively. Okay, so they've got good accounting records. Tavares concluded that FIFO is the preferable inventory method because it reports the current cost of inventory on the balance sheet. Reasonable for a reason to change from LIFO to FIFO. And then we have the following table presents the effects of the change in accounting principles on inventory and on cost of goods sold. All right, make a few notes here what we observed. So from 1/1/2023 through 12/31/2024, Tavares used LIFO. To cost its inventory. Oh my goodness. There we go. Then beginning in 2025, they're going to move to the FIFO method. Okay, so beginning of 2025 moves to the FIFO method. Okay, and then we have some other sentences in there. I don't need to summarize that. Let's take a look at our tables. So inventory determined by LIFO and FIFO, and then cost of goods sold determined by LIFO and FIFO. So obviously at the beginning of the year, January 1, or beginning of their existence on January 1, 2023, everything is zero. And then for 2023, the year, we see that cost of goods sold would have been 800 or 820 versus 180 for the inventory. Then we see what it is for 2024, and then the balances for 2025. All right, we're likely going to need that table, so I'll scroll back to it when we get to it. Other information. So for each year presented, sales are $3,000 and operating expenses are $1,000. All 3 years, sales revenues total $3,000, and for all 3 years, operating expenses total $1,000. Okay, and Tavares provides 2 years of financial statements, and earnings per share information is not required. Okay, what do we need to do? First, part A. Prepare the income statements under LIFO and FIFO for 2023, 2024, and 2025. Okay, let's set up Tavares's statements, income statements. And these are a December 31st year end. 2023, 2024, and 2025. All right, so we'll just start with, what does it want first? LIFO. So let's ask for LIFO first, so let's do LIFO. So we'll have sales, cost of goods sold, and then we'll have operating expenses. We'll do a simple income statement, a one step. And we'll arrive at net income. Then we'll do the same thing for the FIFO method. We'll have sales, cost of goods sold, operating expenses, and we'll have arrive at net income. And we need to set up the years 2023, 2024, and 2025. Let's keep this as a basic number. And we'll do a little formatting here. We'll make this all professional. All right. So for the LIFO method, we know that sales revenue is the same for all 3 years. So that was given to us as $3,000. So we'll just copy that across. So sales are $3,000 for each of our years. We'll add some dollar signs here. $3,000. Cost of goods sold, we'll need to look back into our document above. So let's refer back to the problem. And we see that cost of goods sold for LIFO in 2023 was $800, and then $1,000 in 2024, and then $1,130 in 2025. So let's schedule that out. $800 in 2023, $1,000 in 2024, and then $1,130 in 2025. Operating expenses given to us in the problem said that they were $1,000 for all 3 years. So we'll just simply copy that across. Net income is a function of revenues minus cost of goods sold minus operating expenses equals 1,200 for 2023. Copy this formula over. Again, to show you the formula, it's revenues, sales, minus cost of goods sold, minus operating expenses equals net income. So we have 3 years. 2023, we have $1,200 of net income. 2024, we have $1,000 of net income. And then in 2025, we have $870. So this is the LIFO method, which is the method that they were using since they began. So it did say that since the inception, they were using the LIFO method. So had they stayed in 2025 using LIFO, they would have $870 in net income. Now let's prepare the income statement for the same years for the FIFO method. I'm going to copy down our table and we'll change the things that actually changed. So we know that revenue for all 3 years, sales revenue is $3,000. So that has not changed. And that will not change because of a change in accounting principle. But then we refer back to the problem, and that last column out there is for the FIFO method. Tells us that under FIFO, cost of goods sold would have been $820 in 2023, $940 in 2024, and then $1,100 in 2025. And we see that net income for the FIFO method is $1,180 for 2023, $1,060 for 2024, and $900 for 2025. And the same formula we copied, which is sales revenue minus cost of goods sold minus operating expenses equals net income. All right, so I'll just double check the requirement. It says to prepare the income statements under LIFO and FIFO for 2023, 2024, and 2025. So this concludes part A. All right, let's move on to part B. Part B says prepare the income statements reporting the retrospective application of the accounting change from LIFO method to the FIFO method for 2025 and 2024. Okay, so management's made the decision to change from LIFO to FIFO. And because it's a change in accounting principle, we have to go back retrospectively for all years presented. And it said in point number 2 of other information that Tavares reports 2 years of financial statements. So they're going to report 2024 and 2025 side by side, bankers, etc. So therefore, we're going to prepare in part B the income statement for 2024 and 2025, assuming or reflecting the retrospective application of the change from LIFO to FIFO. So let's set up the same income statement, but following the accounting principle change. So we have Tavares. We are not doing 2023, so we're only doing 2024 and 2025. And let's even do that, what is more customary, where the most recent year is shown first. So 2025 being the most recent year, that is typically put in the first column, and then the prior year is put in the right side column. And we have sales, cost of goods sold, and I see I did not add that here above. I'm sure y'all figured that out. And operating expenses. Okay, if we reflect back to what we looked at, what we completed earlier in Part A, it doesn't matter what year or what method, $3,000 is sales revenue. So let's go ahead and add that on with some dollar signs. All right, so sales revenue is $3,000. Cost of goods sold, however, is going to be reflected because we're now in the FIFO method. We're going to report it under using FIFO. So we look back to our FIFO table that we did in Part A, and we see that for 2024, cost of goods sold is $940 under FIFO. Operating expenses are always $1,000. And so as we found in Part A, for 2024, net income is $1,060. Give a little formatting. Since it is an income statement, it needs to be a formal document. Now we also need to show it for 2025. So we know it's $3,000. The cost of goods sold, we look back at our table, was $1,100 for 2025 under the FIFO method of accounting. And operating expenses are $1,000. As always. Copy over our formula to take 3,000 minus the 1,100 for cost of goods sold minus operating expenses of 1,000 leaves us with net income of $900. So there's our income statement that we will present since we did make the change to accounting for inventory. One other item to add would be as adjusted, and then see note A. And what we're doing here is we are telling a reader that there has been an adjustment to the 2024 income statement. If they had looked at 2023 and 2024, they would have seen it under FIFO. I'm sorry, in the past we used LIFO. So if a user had looked at the financial statements for 2023 and 2024, they would have seen 2024 looks like this. And they would have seen net income of $1,000. Well, why is that not 1,000 over here? Because it's adjusted due to the change of accounting principle from LIFO to the FIFO method. And so a user would be concerned, well, wait a minute, last year you showed this as your two income statements. Why are you saying that 2024 was 1,000, but now it's 1,060? Refer them to a note. This completes Part B. Let's look at Part C. Well, Part C discusses the note. So Part C says, prepare the note to the financial statements describing the change in method of inventory valuation. In the note, indicate the income statement line items for 2025 and 2024 that were affected by the change in accounting principle. Okay, I'm not going to write this whole note out. I'm not even going to tell you exactly what to say. There are examples out there that you can find in the professional world using sec.gov or other access to websites for company financial information. Basically, what we're going to need to do is summarize the facts of the problem, summarize the facts of the accounting change. So you want to say something to the tune of, on January 1st, 2025, the company elected to change its method of accounting for inventory from LIFO to FIFO. Mention the reason for adopting this policy change, which was that it's a better reflection of the cost of inventory. And then talk about the consequence to the financial statements. For example, we see that net income changed. Inventory is going to change. Cost of goods sold will change. So you want to put a table in there for that. Also note that there is no change to cash flows. So it does not change cash flows. It's only changing the balance of inventory at the end of the year. And it will change cost of goods sold for the years. And then there's an impact to retained earnings. So that's the items that you'll want to summarize or add a table for Part C. So I won't actually type that out. I'll leave it to you to determine the specific language you would use. So now let's move to Part D. So Part D asks us to prepare comparative retained earnings statements for 2024 and 2025, just like the two statements for income we prepared in Part B, using the FIFO method. Retained earnings reported under LIFO for the 3 years were $1,200, $2,200, and $3,070. Okay, so let's put together Tavares's retained earnings statement. All right, so we have statement of retained earnings, and it's asking us for the years ended December 31st, 2025 and 2024. So we'll begin with the beginning of the year number. So retained earnings 1/1/2020. Let's go with the beginning. It says begin. Retained earnings beginning as reported. So previously, so we're going to have a column for 2025 and a column for 2024. So what were they previously reported? So if we look back to the problem, retained earnings began on January 1st, 2024 is the same number as retained earnings on December 31st, 2023, the very next day being January 1st, 2024. And that is $1,200. So previously, Tavares reported retained earnings on December 23rd, get this right, December 31st, 2023 of $1,200. And then we're going to adjust that. So it's the adjustment for the cumulative effect of applying new accounting principles. And that new principle or that new method is FIFO. So what was the cumulative impact to that? We want to go back and look at the difference in if we had gone back retrospectively to the beginning of time, which for this company was January 1st, 2023. If we went back to the beginning, we did not show 2023 in our financial statements. We are only showing 2 years, which is 2025 and 2024. So if we look at the impact from 2023, we can see the change between the net income of LIFO, $1,200, and FIFO, $1,180. We see that difference is $20. So we need to adjust the balance of January 1st, 2024 retained earnings by the $20. And that's how we calculated that. And so that gives us retained earnings as adjusted. $1,180. And that matches what net income would have been had we used FIFO since the beginning. So since the beginning, we would have had net income for 2023 under FIFO of $1,180. Therefore, that's what net income needs to be. I'm sorry, that's what retained earnings needs to be adjusted to. And so we've adjusted retained earnings to $1,180. Next, let's continue through 2024. We have net income under the FIFO method, which we prepared right here, was $1,060. And then we'll have retained earnings ending at December 31st. And we can do the math. We adjusted it, retained earnings at January 1st to 1,180, plus we made net income during the year. There are no mentions of dividends, so we can ignore dividends. And we have retained earnings at December 31st, 2024 of $2,240. Add some formatting to help with presentation. Next, let's move into 2025. So the beginning of the year adjusted retained earnings is the end of the previous year. So January 1, 2025 is the same thing as December 31st, 2024, which is $2,240. How much net income did we earn during the year? Under the FIFO method, refer back to part B, $900. Do the same math. We find that retained earnings is now $3,140. And that concludes part D of the problem. And so we've solved for all four parts through a discussion of part C for question 21.3 that relates to a change in accounting principles.